Okay. Ready? All right, guys. Good morning. The day has arrived. 16th of December 2015, landmark day. Landmark day for monetary policy. The Fed will hike. There it is. I've already pre-released the announcement, and they've hiked by 25 basis points. And they have delivered what we call a dovish hike, and they have lowered the sort of trajectory of their dot plot matrix. So there you go. That's an insight into what's going to happen at 7 p.m. tonight. We're going to talk about the Fed, of course, at length. We're going to do a full-on Fed-specific briefing a bit later. So obviously plenty to talk about. Certainly it's going to be the last big, or at least scheduled, dramatic event of the year, and may well help to shape how markets behave into the end of the year and indeed as we track through the beginning part of 2016. So definitely an important day. But let's just, before we get on to the Fed, there is other stuff going on today. We had a big session yesterday, some important moves. So let's maybe, for at least this morning, focus in on some of the data that's coming up, also on some of the data we've already had this morning, and then just think about how markets behaved yesterday and why, and what kind of action we might get ahead of the Fed. We'll focus in and talk about the Fed specifically a bit later on. But yeah, firstly, just look at what's going on here. Obviously, really strong bounce yesterday for equities, continuing that rebound that we got, that really began in the US session back on the 14th. So back on the start of the week, Monday, we had a big break below 2,000 on the S&P. Let me just make this 4-hour chart a little bigger here. Of course, big break below 2,000, and this seems to have been that just sort of overextension bottom, and now we've reversed. And yesterday we added strong upside to what was a strong rebound the day before. It's pretty incredible to think that on Monday afternoon, here we are just Wednesday morning, and on Monday afternoon we were trading down at 1,980, and here we are trading at 2,042. So, you know, a phenomenal sort of 60-point rebound in about 24 hours. A trend line on this chart, which is kind of nicely shaping the December behavior, and we're just in sight of that now. Let me just add another line here, because yesterday's high, of course, is now important. But if we look on a daily chart also, then you know, it becomes clear where we found a bit of, or at least lost a bit of momentum, what was very strong momentum on the rebound higher, with the area where we've kind of run out of steam, at least, you know, overnight it's flat, and we're yet to move above yesterday's high. But here we had some sort of key support back at the start of the month. It's not, we had quite a few lows around here, so it's not clear. And of course, we have moved up above that December the 3rd low, which is at 2040. But ultimately, we closed back below there, and we're just chopping around that price point at the moment. So I think, you know, you can see on this chart, it's still technically negative, even though we've had this huge rebound. We're still technically negative in that we've broken we've broken the upward trend line, and, you know, we remain, you know, around about this 2040 area. So I think on the shorter term, we've got a downward trend line that is yet to be broken. On the longer term, we've broken the downward trend line. So even though we've had the strong rebound, it's still technically negative. We need a move up above 2050, I would say, to really confirm this rebound as the beginning of a move back to the top, back to 2100, rather than it being just a temporary or a dead cat bounce, as we would call it, which is a bounce in what is otherwise an ongoing downward trending market. So I think technically around this area, around 2040, let's just say yesterday's high and this downward trend line are technically important. But of course, it will be the Fed that determines where we go from here. Is this 60-point rebound valid? Is there scope for more than a 60-point rebound off the back of the news tonight? Or is this rebound not valid and we reverse back to 2000? This will entirely be in the hands of Janet Yellen and her statement and her press conference that's coming tonight. But yeah, really strong response. I guess often you'll see, we've spoken a bit about this, but often you'll see that once the rate hiking cycle begins, you actually get counterintuitive movement in markets, because markets have priced in the rate hiking cycle actually before it even begins. And often you'll see once rates start going up, then you'll get reversals. It does seem that these reversals have begun sort of 24, 36 hours early. So actually even before the hiking cycle begins, you're getting this bounce. And it's not just on equities, of course. We've had some pretty big moves yesterday across the spectrum. Of course, this upside on stocks was certainly helped by the energy space and commodities more broadly, as we saw a second day in a row of upside for crude oil. So here on crude, we bottomed out at 34.50. Yesterday, we tested the key August low, 37.75, and that's what brought to an end another impressive day to the upside. But I guess like equities, and even more so, actually definitely more so, we're in a downtrend here, and despite two big up days, we're definitely still in a downtrend. There's no question. This August low is massive as a technical barrier, and on first test yesterday, it held very firm, and we're over $1 off that. So we got oil inventories today, remember. So it's not just about the Fed, but I think very important that August low was able to cap the upside. And so we just kind of track, we're about mid of yesterday's range at this point. So certainly the energy rebound helped with the equity, the continuation of that equity rebound. I think it was a big day on, if you're looking at bond yields rising. You got a big move to the downside, big breakout move on the Bund yesterday, where we've just bounced a touch now. But yeah, yields lifting, I guess, as crude oil pushes higher, seems to be the theme, and you're getting some dollar strength as well. I mean, the dollar's been notably weak over the last few sessions, coming off obviously a multi-month rally. The dollar has been weak, but yesterday we had some dollar strength, certainly with euro dollar trading down. We had about 140 pip range on the euro dollar yesterday. These are not small moves, so it was a pretty big day for movement without there being any massive new sort of catalysts to drive it. We got some data, of course, and actually if we just take a look at the US inflation, and it is important ahead of today's decision, of course. Here's the core inflation number, perhaps the most important number from yesterday, and it came in line with expectation. But the important thing is that means we're at 2%. I mean, it's almost like this was scripted. The day before the Fed meeting, where they're going to hike rates for the first time in 10 years or 9 years, literally the day before, finally, you get core inflation hitting target. It's almost like the timing is suspicious, let's say. But it is important that here we are at 2%. We're going to talk a lot about the Fed, of course. But as it stands, this again probably a bit of a sigh of relief from the Fed as these numbers hit the wires yesterday. The final bit, if it was needed, the final piece of information to cement their decision to hike, which is almost certainly going to happen. So, and if we just have a very quick look at the Fed, I'm going to talk much more about this later. But here's, I would say, the most important chart of the day. Unless something incredibly unexpected happens, which would be the scenario where they don't hike rates. Now, just assuming that doesn't happen, then if they do hike rates by 25 basis points, then the most important chart in the world on December the 16th, 2015 is this one. This is the Fed dot plot. And what we've got on this chart is market expectations. So this is not, are we going to hike rates today or not? This is, what's the trajectory of the rate hiking cycle? And we're definitely going to get changes. All these dots on this chart are the Federal Reserve members themselves putting down on paper where they think interest rates are going to be at the end of each year. So at the end of 2015, the end of 2016, the end of 2017, the end of 2018. Where do they think rates are going to be? Where do the people who control interest rates think they're going to be? Now, these are all going to get revised lower. It's just how much lower. And check out how different market expectations are compared to the average median Fed forecast from the last time they changed the dot plot, which was back in September. There's a big difference here. What we're expecting today is a hike, but we're expecting this top line, the Fed median forecast, we're expecting that to move towards market expectation. This is what a dovish hike would look like. They hike, but they lower the dot plot matrix, implying that, for example, we're not going to get 4 rate hikes in 2016, we might get 3. All right, so this becomes the all-important focal point for how markets are going to behave in the rate decision. Well, not the rate decision. That same chart, and as you can see, these red dots. This is the actual individual Fed members putting down on paper where they think rates are going to be. We've got some uber ridiculously hawkish member in September. So just 3 months ago, one of the Fed members suggested that rates at the end of 2016 will be up at 2.75%. If they're anywhere near right, then we've got an ugly 2016 ahead of us. They're not right, and so they're going to have to revise their projections lower. Remember that we're going to finish the end of 2015 at 0.5%, assuming everything goes to plan today. We will finish the end of 2015 at 0.5%. So even if they have 4 rate hikes next year, 1 per quarter, 0.25% each, then of course that only takes us to 1.5% by the end of 2016. Okay, that's way more than what the market currently expects. So we're going to need to see, markets are currently expecting more like a rate of around about 1.25% at the end of 2016. So maybe 3 rate hikes next year, whereas the Fed actually on this current chart, yeah, it's at least 4, at least. So we're going to need to see the Fed lower their dots. And the question is, how far will they lower them? If they don't lower these dots, I mean, I can't see how it's possible for them to leave them where they are. But if the average stays the same, that's a hawkish hike, and you're going to get some decent reaction. I would say the biggest event tonight is a hawkish hike. Well, outside of no hike at all, which is phenomenally unlikely. But just assuming that doesn't happen, the biggest event will be a hawkish hike. This is where the dot plots stay where they are. So we'll talk about this in detail later. Okay. Just for now, just thinking about, well, we'll talk about it later. I had another chart looking at probabilities, but I'll talk about that later. All right, let's just focus in on this morning. So we've already had some data on the manufacturing PMI and services PMIs. These are preliminary figures for the month of December. Here's the German number. What seems to be happening this morning is that the manufacturing numbers are beating expectation and the services numbers are doing the opposite, and therefore the overall, what we call the composite PMI, is roughly in line to slightly lower. So it's all pretty much, I guess because one's good, one's bad, and net, they're not far off neutral. It's probably why you're not really getting too much response to this. But it does mean, it does put the German manufacturing number, second best reading of the year. So, it's none too shabby. The Eurozone as a whole, and we're going to get this data, we haven't had it yet, we'll get this at 9 o'clock. What's important about the manufacturing number in Europe is for November, we had a real push up through that kind of summer high, that quarter 2, quarter 3 high, and into new territory. So Eurozone manufacturing as a whole has made a new high here. If we just take this chart to a 5-year time frame, then you'll see we've got a bit of work to do, but the target is to get back to the sort of start of 2014 high, and we're not far off it now. So actually, this is a pretty decent improving trend. Although 2014 peaked at the start of the year and we drifted lower for the whole year, 2015 has seen that turn, and it's been a pretty decent year for manufacturing PMIs, a further indication that as we hit 2016, the Eurozone is going to be the economy that perhaps shows the most positive trend in growth. So we'll see. Let me show you the calendar, because this Eurozone number is coming at 9 o'clock. Okay, so we're expecting the manufacturing to be at 52.8, which is the same as November, but it's likely that's going to be slightly higher. We might get a 53, just going off the fact that the French and the German manufacturing numbers have beaten expectation. But then to counter that, we'll expect the services number to be lower than expected. So we're expecting it at 54, and it's most likely going to be lower than that. But net, it's probably going to be neutral, because we've got good news and bad news here. Then we hit the UK labour market data at 9:30. We've already had let me just bring in the chart cable here on the daily time frame. Dollar strength yesterday pushing us down onto the November the 6th low. We're just sneaking down through that now. So more sterling weakness. We're around about that 150 handle. Carney's been a little bit dovish in the FT this morning. And he does, I don't know, it's easy to be critical of central bankers. They do make it easy for us to criticize them. I'll give them that. It's just that the number of times they change their communication, it's not so long ago, and I mean weeks, that Carney was saying that, by the time we get to the end of the year, rate hike changes will be brought more into focus. Well, here we are at the end of the year, and now he's backtracking, and it's very much cautionary tone, and it's not right to think about hiking yet, and he's turned back dovish. But I do sympathise, having criticised them a lot. I do sympathise with them at the same time, because he said that, the energy markets didn't send me a memo 6 weeks ago to tell me that they were about to drop by 15%. So I didn't get that memo in advance. And he said that, China didn't tell me that we were going to get a sort of downturn with regards to sentiment about their growth that would have an impact on energy. So sorry for not being able to predict that commodity markets were going to have another big move lower. Sorry about that. But it does mean my inflation expectations have changed, and so therefore it's my job to change my guidance on interest rates. So I can I do sympathize with him. Trying to predict inflation is a mug's game. And we'll talk a bit later, because there's a chart I want to cover about long-term inflation expectations, which is really just trying to look at inflation in 10 years' time. It's the most pointless exercise, literally the most pointless exercise, and yet monetary policy seems to be shaped by this idea that we have projections for inflation out over 10 years. It's a nonsense anyway. Right, sterling's on the back foot, down through the start of November low. And so this downward trend, I showed you this chart yesterday, real nice confirmation of this trend line this week, and indeed end of last week on Friday when we pushed up above the 152 handle briefly. So very much still downward trajectory here. And I think the euro dollar often gives you a slightly misleading view on the dollar's behavior, because obviously the euro dollar's had a sensational bounce over the last few weeks, the last couple of weeks, but it's all about the euro here. But it looks like the dollar has weakened dramatically. It hasn't, though. The dollar has strengthened against everything dramatically, except for the euro. And because we spend so much time looking at the euro dollar, I think it perhaps does give you a slightly misguided view on the dollar's behavior. So the dollar has been strong. I'll show you some charts on that later when we think about what that means for the Fed. So labour market data out of the UK at 9:30. We get European inflation numbers for November at 10 o'clock, where we're expecting the core number to stay unchanged at 0.9%. I mean, really, this is now not that interesting. We've had the big ECB event this month. They haven't done what we wanted. We've seen some decent data from Europe in December, and on Fed Day, I don't think this is going to carry as much impact to markets as it would do otherwise. I mean, normally this would be a big data release, but I think we've had the big moves. We've had a big bounce in stocks Monday afternoon and Tuesday, and I think most likely we're going to see things settle down until we get this key news flow later. We do have some important data out of the US, though, as well. Housing starts, building permits, industrial production, the manufacturing PMI numbers, also the Department of Energy numbers. These are all, in their own right, interesting pieces of information. It's just that 7 p.m. event, plus the 7:30 press conference, of course, trumps absolutely everything. And so market reaction to this data this afternoon is probably going to be a significant amount less than it might ordinarily be if it wasn't Fed Day. And it's not just any old Fed Day. It's Fed Hike Day, and that's an event. Well, I imagine that anybody listening to this you probably haven't ever traded a Fed rate hike, because if you've been trading for less than 9.5 years, then that is true. I've traded a Fed hiking cycle. It's so long ago I've forgotten everything about it. So we'll try and remind ourselves and look back this afternoon as we prepare for tonight. All right, let me leave you to it. Just technically, a few interesting things then, just to say the DAX hitting the November the 16th low yesterday as resistance. It's today's high as well. Oil hitting the August low yesterday, really key resistance. We've got this downward trend line on the S&P to look out for. So let's get moving. We've got 1.5 minutes to the Eurozone manufacturing and services PMI data. All right, enjoy.